Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Debt Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch. Hello, everyone. We've gone from a week or two where the buzzword all around the markets was stagflation to this past week where the phrase du jour is that of a policy mistake. So a lot of this is coming to the head in the UK, where the Bank of England speakers this week chose not to push back on market pricing of rate hikes by February of next year, which in turn caused markets to then push that even further to the point where rate hikes are somewhat priced for the end of this year. The proclivity of UK asset markets to overshoot aside, what's interesting is that at one point, the rate curve in the UK showed expectations of rate hikes through the coming year and then a slight probability of cuts after that. Now, this is where the policy mistake phrase comes into play, where investors seem to be increasingly concerned that if current inflation persists, central banks, led by the Bank of England, will be forced to tighten into what is broadly seen as a supply shock. So that results in a lower demand. And if the supply shock and supply shortages ease, and you come out on the other side, you have lower demand, supply returns to normal, thus you have the impact growth through the lower demand channel, and prices come back because of things that actually aren't under the central bank control. So you end up with a worse result on the other side. This is really an offshoot of our previous stagflation discussion, where you have inflation and slowing growth. So if you add rate hikes into that, you might control inflation to some degree. That's arguable because it's a supply chain issue. But you also hit growth even more, and that leads to that unpleasant outlook. So it's why you've seen curves flatten in the UK, but also in the US. I'm not necessarily talking about policy mistakes in the US, but it's a similar, if less alarming dynamic. We have front-end yields rising to account for higher potential central bank rates. But the long end yields fall as investors think that as the central banks do raise rates, down the road, they're impacting the growth outlook, and they might even have to reverse course, and you have a lower terminal rate, lower growth outlook, and lower inflation down the road. So that keeps the longer end rates under control. But as listeners know, and many who are in the UK are personally aware, a lot of the recent worries around inflation surround the energy side of the equation, where Brent and WTI oil are now over $80, and natural gas prices have seen extreme moves in the last few weeks. So here I'm going to bring in our co-head of G10 FX strategy, Brian Daingerfield, who also covers energy markets for us. Brian, we had you on a few weeks ago. What's the update here? In your view, what's the forward path for energy prices?
Thanks very much for having me, John. So I think we can say with maybe a little bit of confidence here that maybe the worst of the spike in energy prices may be behind us. And if we think about the energy complex as a whole, there's a couple of different products we're thinking about. Normally, we like to focus on crude oil, but really the driver of late has been natural gas, certainly at the end of September in particular in the United Kingdom, but really across Europe for the last couple of weeks. You've seen a near parabolic rise in natural gas prices, but that has since stabilized. One of the big drivers of this move, we think, relates to Russian exports of natural gas into Europe. That's a big source of natural gas for the region. We're coming into a period now where natural gas demand naturally rises simply because of the temperature. As temperatures cool, natural gas is used in heating, and so therefore demand rises. But like a lot of different products where supply is impacted by whether it be labor or shipping issues or whatnot, inventories are at extremely low levels. We're at essentially decade low global inventories for natural gas at a time when seasonal demand is already rising. And now one of the specific triggers we can look at is expectations around the specific Nord Stream 2 pipeline coming from Russia into Europe. The German regulator needs to approve that pipeline before it's able to be used commercially to increase shipments of natural gas into Europe. One of the things the regulator said is that they might not give a decision on that approval really for the entire winter. They have basically gave themselves a window of approval through the winter. And so expectations of supply of natural gas from Russia into Europe had to really come down quite a bit because of that decision. And I think that's part of the reason why natural gas prices move so much higher. So as we think about natural gas, when Russian President Putin came out and said, we are going to supply natural gas to Europe in full, we will fulfill our commitments. I think that's why you've seen such a dramatic fall from the height in natural gas prices in Europe, because this dynamic is so important, Russian natural gas into Europe. Now, is President Putin, using high natural gas prices as an opportunity to take advantage of a crisis in Europe. I think it's probably fair to say that there's some expectation from the Russian side that the Nord Stream 2 pipeline would be approved as part of this, that, hey, we will provide all the gas you need, but you should also approve our pipeline. So I think it's because of that, because of the expectation that Russian gas is going to be flowing, perhaps the worst of the spike may be behind us. But look, we have essentially record high natural gas prices, and that's driving higher the rest of the the energy complex. Coal prices and crude oil prices are rising as well because of switching. And so, in any, we have natural gas prices at record highs. Relatively speaking, oil is not as high. And so that's helping drive upside. And so maybe the worst of the parabolic rise is behind us, but the dynamics looking from 30,000 feet down is we have high demand and we have low supply and we have low inventories. And so that's the kind of recipe that calls for higher prices still.
Okay. Yeah, everybody still seems to be talking about upside risk. Like you said, we've had that parabolic rise seems to be past, but if you look at it and just take that recent spike in return out, prices are still very high. So, again, lots of people talking about upside risk, but is there anything that can more sustainably, Russia aside, push prices lower? Is there any way that we should be thinking about downside risks, or is it just all one direction right now?
Well, I think, I just mentioned that the core issue in energy markets right now is not enough supply and high demand. And so what would cause the reverse to happen? You need one of those two factors to move, either a significant increase in supply, a rapid increase in supply. That just looks unlikely at this point. Now, the specifics of supplies of natural gas from Russia into Europe, that can change based on their ability to ship to that specific region quickly. But natural gas and oil, and like a lot of different commodities and a lot of different products, honestly, faces the same kind of challenges that a lot of the supply chain globally is facing because of the pandemic. And so a rapid increase in supplies, whether it be crude oil from OPEC or from the US for that matter, or natural gas from Russia and other places, the kind of spike in production that would be needed to change that story durably looks unlikely in the near term. So really, when we're thinking about downside risk, we're thinking about the negative ones, something from the demand side. So whether we have, God forbid, outbreaks of COVID, either significantly worse Delta variant spread or, a new variant risk, something that significantly reduces demand for travel and oil. Or you have, as you mentioned at the outset, John, the possibility that central banks tighten policy more aggressively than hoped, than expected, which essentially can work to curtail demand for essentially all products, curtail growth momentum and demand for raw materials. And so it would probably have to come from the demand side when we think about downside risk, simply because the supply side looks like it's, the physical market has been tight and is likely to continue to be tight. Now we think about energy markets and we think about the transition sort of from a longer term perspective, the transition away from fossil fuels and towards, cleaner sources of energy, ESG. What does that mean for investment in this industry over the long term? Those are the kinds of challenges that are likely going to continue to hang over the supply side for a lot of these markets for a long time. And so we think about downside risk, it's probably the demand side that we would be focused on.
Yeah, so it's an interesting distinction because I think, if you increase supply, prices go down, that's probably not a bad reason. But if you destroy demand for whatever reason, central banks, COVID, anything else, and prices go down, that's not really a good reason. So very much of a distinction there. So thanks for that, Brian. We'll see how this all plays out. For the coming week, none of these issues are going to go away anytime soon. So we're going to be looking at much of the same. But we're also, going to be checking back in on this stagflation policy mistake, or just see if the markets quickly jump to another theme as quickly as they've jumped through these. What's one more thing for me to comment on is that I think is interesting is the risk asset response, which given everything so far, I personally think the risk assets have held in remarkably well. we are also in the heart of U.S. earnings season, so we'll see if that's been a factor. But there's been some volatility, but overall the markets have performed better than I would expect. Hopefully, we can get through a lot of this volatility in energy prices and get to the other side without, again, too much damage. So on the official calendar next week, we also have the preliminary PMI data out of the UK and Europe. And on the inflation front, UK CPI. So given what we discussed about the Bank of England and hawkish speakers and what's been happening in the rate market there, which is spilling over into other markets, that CPI print could certainly be interesting and potentially the highlight of the week. So that's all for this week. Thank you, everybody, for listening, and talk to you next week.
I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.